Hey everyone, Andre Jik here, ready to dive into the fascinating and sometimes perplexing world of cryptocurrency. Today, let's talk about a strange puzzle in the crypto world, a divergence that's got many investors scratching their heads. We're going to unravel a situation that highlights the complexities and nuances of this digital landscape, specifically the Pi network. This is a project that promised to democratize cryptocurrency mining, making it accessible to anyone with a smartphone. Pi promised easy phone-based mining, a concept that resonated with a lot of people looking for an easy entry point into the crypto space. The idea was simple: contribute to the network and earn Pi coins, all from the convenience of your mobile device. And grew a massive community, attracting millions of users worldwide who believed in its vision of a more accessible cryptocurrency. This rapid growth created a buzz and a sense of collective participation. But now its value is dropping fast, leaving many early adopters wondering what went wrong. The initial excitement has faded, replaced by concerns about the project's long-term viability. What's odd? What makes this situation particularly noteworthy? This is happening while the rest of the crypto market, led by Bitcoin, is booming. We're seeing a resurgence of interest in digital assets, with many cryptocurrencies experiencing significant gains. Bitcoin is smashing records, reaching new all-time highs, and capturing the attention of mainstream investors. The overall sentiment in the market is bullish, with many analysts predicting further growth. But Pi holders are watching their investments shrink, feeling the sting of a market downturn while others are celebrating. This stark contrast highlights the risks associated with investing in less established cryptocurrencies. It's like being left out in the rain while everyone else is at the party, a frustrating experience for anyone who believed in the potential of Pi network. The feeling of missing out on the broader market rally can be particularly disheartening. Why is Pi falling when everything else is rising? What factors are contributing to this divergence, and what does it tell us about the crypto market as a whole? Is it a project problem, stemming from internal issues or a lack of development progress, or something bigger, reflecting broader market trends and investor sentiment? This isn't just about one coin, it's a lesson in market dynamics and trader psychology, offering valuable insights into how different cryptocurrencies can perform in varying market conditions. Understanding Pi's situation can teach us how to navigate crypto's chaos, helping us make more informed decisions and manage our risk effectively. In this video, we'll break down Bitcoin's surge, examining the factors driving its impressive rally and what it means for the future of cryptocurrency, Pi's struggles, analyzing the challenges it faces and the reasons behind its recent decline, and what traders are doing with their money, exploring the investment strategies that are proving successful in the current market environment. We'll also look at a new player, RTX, a project that's generating buzz and attracting attention in the crypto community, and see what history can teach us, drawing lessons from past market cycles and applying them to the current situation. Most importantly, you'll get practical takeaways for your own portfolio, actionable advice that you can use to make informed investment decisions and manage your risk effectively. Let's dive in and solve the puzzle, uncovering the underlying factors that are shaping the crypto market and influencing the performance of individual cryptocurrencies. Stay tuned for the full breakdown. We're going to leave no stone unturned in our quest to understand the dynamics at play. Let's get into it. Let's unravel this crypto mystery together. First, let's set the stage. We're entering a period of renewed excitement and opportunity in the cryptocurrency markets. Understanding the broader context is crucial before we dive into specific projects. Bitcoin is on a historic run, breaking all-time highs. This isn't just a minor uptick. We're talking about shattering previous records and establishing new benchmarks for the entire digital asset class. The momentum is palpable, and investor sentiment is overwhelmingly positive and pulling the entire market up. Bitcoin's surge is acting as a catalyst, creating a ripple effect that's lifting almost all cryptocurrencies along with it. We're witnessing a broad-based rally, indicating strong underlying demand and renewed confidence in the long-term potential of crypto. Ethereum, Solana, and other top coins are seeing huge gains. Altcoins in particular are experiencing significant upward movement, with many projects posting double-digit percentage gains in a short period. This widespread rally suggests a healthy and vibrant market. Institutional investors are piling in, and positive regulations are fueling the rally. The increasing involvement of institutional players is adding legitimacy and stability to the market, while clearer regulatory frameworks are reducing uncertainty and encouraging further investment. The total crypto market cap is swelling, and optimism is everywhere. Market sentiment is overwhelmingly bullish, with investors expressing confidence in the continued growth and adoption of cryptocurrencies. This positive outlook is driving further investment and fueling the upward trend. In a healthy bull market, capital flows from Bitcoin to large-cap altcoins, then to smaller projects. This rotation of capital is a classic sign of a maturing bull market, as investors seek higher returns in riskier but potentially more rewarding altcoins. This rising tide should lift all boats. So why is Pi sinking? In the face of such widespread gains, the underperformance of Pi network raises serious questions. The contrast is sharp. While most coins soar, Pi is falling. This divergence from the broader market trend is a cause for concern and warrants a closer examination. The market is sending a clear signal. Something is wrong with Pi specifically. It's not simply a case of bad timing, there appear to be fundamental issues affecting the project's performance. When a coin drops in a bull market, it's not just bad luck, it's a red flag. Such a significant deviation from the prevailing trend suggests underlying weaknesses or problems within the project itself. This is the context you need as we turn to Pi Network. Understanding the broader market dynamics is essential for accurately assessing the challenges and opportunities facing Pi Network. The crypto world is thriving, but Pi is missing out. While other projects are benefiting from the rising tide, Pi Network seems to be struggling to stay afloat. Let's find out why. What are the underlying factors contributing to Pi Network's underperformance in this otherwise booming market? The answer lies in project fundamentals and market psychology. A combination of internal factors and external perceptions is likely influencing Pi Network's current situation. Let's dig deeper. We need to analyze the project's core principles, its community engagement, and its overall market positioning to understand the root causes of its struggles. So, why is Pi Network falling while the market booms? The biggest issue: endless delays in launching the open mainnet. Pi's promise was tradable coins, but that day keeps getting pushed back. Trust and patience are wearing thin. There's also a lack of real-world utility. Few places accept Pi and the ecosystem is closed. The coin's value is pure speculation with no clear use case. Meanwhile, billions of coins have been mined, creating massive potential supply. Investors fear a huge sell-off if the mainnet ever launches. Competition is fierce. New projects offer real utility and returns right now. In a fast-moving market, waiting for Pi means missing out elsewhere. The longer Pi delays, the more it falls behind. Traders are losing faith and moving on. Let's talk trader psychology. Pi holders are frustrated and feeling FOMO as other coins surge. No one wants to hold a losing asset while others get rich. This pressure triggers the Great Migration. Traders are selling Pi and moving to better opportunities. As more sell, Pi's price drops further, creating a downward spiral. The money leaving Pi doesn't disappear. It flows into stronger assets. This is capital rotation. Traders chase momentum and abandon laggards. Pi is now seen as a laggard, so smart money is leaving. Traders are reallocating to Bitcoin or newer, more exciting projects. This is a natural part of market cycles. The market rewards strength and punishes weakness. Pi's decline is a textbook example of this process. Let's see where the money is going next. So where's the money going in the ever-evolving world of cryptocurrency? It's a question on every investor's mind, as fortunes can be made and lost in the blink of an eye. Besides the established giant, Bitcoin, a significant amount of capital is flowing into a relatively new concept, RTX, or real-time experience tokens. These tokens are quickly gaining traction and capturing the attention of the crypto community. Now, before you jump to conclusions, RTX isn't solely about graphics cards or the hardware that powers your gaming rig. Instead, it represents a new and exciting crypto category that's intrinsically tied to live, interactive platforms and experiences. It's about creating a dynamic and engaging ecosystem within the blockchain space. Think decentralized streaming platforms where content creators and viewers can interact directly, free from centralized control. Consider blockchain gaming, where players truly own their in-game assets and can trade them freely. And imagine immersive virtual worlds where instant transactions are seamless and secure, enhancing the overall user experience. Unlike some crypto projects that promise future utility, RTX projects offer immediate utility and tangible benefits to their users. Unlike Pi, which is still in development, these platforms are live, functional, and usable right now, providing real-world applications for their tokens. Users can actively participate in these ecosystems, whether they choose to play games, watch engaging content, or spend their tokens within the platform, all in real time. This immediate and practical use case is a major draw, attracting traders and investors alike. They are hungry for action and eager to capitalize on the opportunities presented by these dynamic platforms. Holding Pi, in contrast, is akin to patiently waiting for a highly anticipated theme park to finally open its gates. RTX, on the other hand, is the theme park that's already open, buzzing with activity and ready for visitors today. In the fast-paced world of crypto, traders crave immediate experience and gratification, not delayed promises of future potential. It's important to acknowledge that RTX is still a relatively risky and nascent market, but in the midst of a bull run, where market optimism is high, risk appetite tends to increase significantly. Therefore, the observed migration from Pi to RTX can be largely attributed to traders actively chasing performance and seeking opportunities for substantial returns. It's crucial to remember that not all RTX projects will ultimately succeed or stand the test of time, but the current hype and excitement surrounding this new category are undeniably real and palpable. This emerging trend represents the new narrative that is currently capturing the market's attention and driving investment decisions. So, let's delve deeper and explore how this phenomenon fits into the broader context of cryptocurrency's history and evolution. If you've been in crypto a while, this all feels familiar. Every bull run, traders rotate out of old, underperforming projects into the next big thing. In 2017, capital moved from outdated coins to ICOs on Ethereum. In 2021, it shifted from zombie chains to DeFi and NFTs. The market is ruthless. It rewards momentum, not loyalty. Pi's struggles aren't unique. They're part of a predictable cycle. New tech and narratives always attract capital. Projects that adapt thrive. Those that stall get left behind. Holding on to laggards in a bull run rarely pays off. The lesson: follow the trends, not the nostalgia. Crypto history repeats itself. Don't get stuck in the past. Let's talk about how to navigate these shifts. So what should you do? Here's a framework. Be brutally honest about your portfolio. Judge assets by performance, not hope. For Pi, ask, do you still believe? Are you willing to wait and miss the bull run? Manage your risk. If you stick with Pi, consider reducing your position. If you rotate into RTX, know the risks. These are speculative plays. Only invest what you can afford to lose. Diversify and size your positions wisely. Do your own research, don't just follow hype. Study the teams, tokenomics, and real user numbers. For Pi, watch for real updates, not just promises. Always have a plan. Set entry and exit points before you invest. Without a plan, you're gambling. A strategy gives you the best shot at surviving crypto's volatility. To wrap up, today's crypto market is a tale of two cities. Bitcoin and most coins are booming, but Pi is struggling. Delays, lack of utility, and competition are driving Pi's decline. Traders are rotating capital into leaders like Bitcoin and new narratives like RTX. The market rewards momentum and real utility, not just promises. Adaptability is key. Don't get emotionally attached to any asset. Assess trends, manage risk, and position your portfolio for strength. History shows these rotations are normal. Be ready for them. Success comes from staying informed, disciplined, and rational. Do your research, cut losses when needed, and keep learning. Thanks for watching. See you in the next video. Looking ahead, both Pi Network and RTX face big challenges. For Pi, everything depends on finally launching a real, usable mainnet. The user base is huge, but it means nothing without working tech. Time is running out for Pi to deliver. RTX, meanwhile, must survive the hype cycle. Most projects will fail. The winners will have real tech, strong communities, and sustainable models. The market is brutally efficient. Money chases momentum, not patience. Timing and narrative matter as much as fundamentals. A great idea at the wrong time can flop. An average one with hype can soar. Watch capital flows as closely as you watch fundamentals. Be critical, demand results, and manage risk. Crypto evolves fast. Adapt or get left behind. Stay sharp, and you'll be ready for whatever comes next.